Hello everyone, my name's Andrew Tam and today I'm joined by Varun Venkatraman. We are both equity analysts at CFRA Research's London office. I focus more on the consumer name whilst Varun looks at more of the industrials. So today we're going to take a brief look through some of our key observations and takeaways from the first quarter results in 2021 within the European market. And of course, our discussion is, as always, for informational purposes only. It's not a recommendation to buy or sell securities or engage in any investment activity. With that out of the way, so Varun, it's been a flurry of a reporting season. What would you say is your first key takeaway, I suppose, for this first quarter?
Well, from an industrial sector point of view, there's been a strong improvement in revenue and order book growth in the first quarter. And a lot of that's been driven by a demand whip effect for short cycle products. So when economic activity tumbled in 2020, a lot of end users froze production and they just dropped the order volumes and they wanted to conserve cash and liquidity and not be producing much. We saw that especially on the smaller items, like your generic nuts, bolts, little pumps, boiler units, also through to some larger items like car windscreens. So now those end users have run out of inventory and consumer demand is starting to rebound, and the producers are desperate for more inventory so they can produce more and catch up for what they lost in 2020. And we've seen this play out on several diversified industrial businesses, right from Siemens to ABB and IMI PLC. But it's not just a story of increased volumes. Margins have gone up too. Most of these producers managed to raise their average selling price in response to the spike in demand. But at the meantime, they're also cutting their costs in response to the pandemic. So what we're seeing is order book growth, and that's leading to book-to-bill ratios over 1. And by book-to-bill ratio, I mean the ratio of incoming orders versus the sales during the period. So when the order intake's higher than revenues, it's a forward indicator that there's future growth in the pipeline.
Yeah, no, I think I'd have to echo those sentiments. I agree with that. I mean, that's certainly a trend that, from covering the automakers, 12 months ago, really they were staring down the barrel of, production suspensions. They had really uncertainty, a large amount of uncertainty on the impact of, on consumer and demand. So car makers were really rushing to, cut as many costs as quickly as possible from a tactical point of view, and then really release as much working capital, lower inventory levels, really to raise those liquidity levels and cash levels to really help them steer, through that crisis. But what you really saw, I suppose, since that, that first half at the start of the pandemic, was a really strong bounce back in that second half last year. And that's really continued well into, this current first quarter in 2021. So in many respects, it was definitely a better than expected first quarter, and you really saw quite material earnings upgrades really across the reporting season. So, first quarter, you saw that production backlog, as you mentioned, from those suspensions, really combined with, a really healthy consumer. And that's meant that really orders have really continued to flow in. And then when you layer on things like, the unprecedented e-commerce demand, and that's seen a real big rush towards things like light commercial vehicles, so your vans and your lorries and things like that, really to satisfy all those online deliveries. So ultimately what you saw was, the likes of BMW, who saw, their units delivered, up a third to over 600,000, group wide revenues up, 15% year on year for the quarter. Similar story at Volkswagen, 21% higher units, 13% higher revenue growth. And really, as well for those guys, their electrification strategy really seemed to be gaining traction with investors as well. But it's not a full-blown recovery across the sector, though, is it, in terms of across the market? There are really pockets of strength, but things are still a little bit patchy.
Yeah, absolutely. Especially in the industrial sector, it's definitely a patchy recovery. Some sub-industries are a lot stronger than others. What we need to see is continued growth in demand for the larger ticket items. So now that's the stuff driven by customers in expansion mode, their growth capex, if you will. So for this recovery to maintain momentum, we need to see them ordering robotics, automation equipment, setting up new factories, thermal systems, the stuff that's used to build bigger production facilities. And that's what ultimately drives a longer, stronger recovery. And I think those large value orders, they will be driven by increased economic activity that we're seeing now, and I think more of that's going to gather pace. If you think about the various stimulus programs we've had, monetary and fiscal, all across Europe, UK, North America, it's starting to drive things like automation in factories, right? The electrification plan, the UK's plan, or even President Biden's plans for achieving combating climate change. Those demand that end users start improving their emissions, the technology they're using in their factories. So all these sectors are going to start spending a lot more money. That's one side of things. And on the other, as you said, automotives, as the sector starts to open up again, people start buying cars again, there's going to be more demand there. Similarly, in home building, that just has not slowed down across Europe and America and the UK. It keeps going from strength to strength. And finally, when air travel resumes, the entire aerospace sector as well. So on the patchiness of this recovery, we're seeing this at the geographical level as well. Orders from regions which quickly recovered from the pandemic have been really strong. So take Asia and Australia, for instance. Clients of industrial businesses located there, they were able to resume ordering large amounts, much larger than usual, quite quickly as they recovered faster, at least from the initial surges of the pandemic. Europe and America has lagged, but there's signs starting to appear now that America is picking up pace. And this is just following the trend with the rollout of the vaccine. So eventually, as Europe and UK catch up, which they're doing so quite aggressively at the moment, we think the recovery will start to pick up in bits around here.
For sure. So on my side, from a consumer perspective, I mean, you've seen those geographic differences really come to the fore during the quarter as well. And you really saw that clearest in the first quarter sales results of the luxury brands, I suppose. So here you saw the likes of Hermès, they saw Asia Pacific sales, which were up 68%, which really helped them offset the 6% declines that they saw across Europe. You know, Europe was understandably quite patchy during the quarter, given all the lockdowns. You know, but we expect things to really improve from here, given that, you know, stores are allowed to reopen and those restrictions are gradually removed. You know, that story of a strong Asia Pacific offsetting a weak Europe, that's really played out, you know, across numerous consumer names as well. And then on the travel side of things in particular, you know, unsurprisingly, things have been rather tough there, you know, so I suppose you've had travel restrictions really plaguing during the quarter. You know, the likes of Accor, Intercontinental, you know, revenue per available room, or RevPAR as they call it, you know, plummeting 64% and 51%. And then cruise ship businesses, which are effectively in hibernation, their revenues have effectively been zeroed out. So for those guys, it's really more about minimizing the cash burn, you know, biding their time, fortifying the balance sheet, and really maintaining the ability to emerge out of it and come out on the other side to participate on, you know, the strong recovery in travel. But for us, we think, you know, that these guys could survive given the significant liquidity that they've got, you know, the access to the capital markets as well. You know, but they're very much beholden to their creditors given their, you know, outsized debts. And it'll be a few years yet before really, I think that, you know, shareholders will see any cash flows, not to mention the significant dilution, you know, that's taken place, you know, given all the equity raisings and whatnot. So we're still a little bit bearish, you know, on the longer term picture on this sub industry, irrespective, I suppose, of any near term recovery in travel. And then finally for me, I suppose, is, you know, changing tack, is that, you know, the traditional stores locked down and closed. You really saw, you know, this consumer names and retailers that who could trade through this through their online channels. Those with the omni-channel propositions really outperformed. So the first quarter really saw significant resilience from those guys that had those propositions. So a case in point, you know, the clothing retailer in the UK Next, you know, we saw that, you know, their online sales till the end of April this year, you know, they were up 65% year on year. Meanwhile, their, you know, store sales, their physical store sales, they were down 76%, and they roughly got a 50-50 mix as well. So really, they were able to navigate those tough lockdowns quite successfully. But yet overall sales, I mean, they were still relatively resilient, you know, just down 2%. But overall, you know, since the reopening, they've seen better than expected sales, which has seen them upgrade their base case earnings guidance, you know, by up another 3%. And there's plenty of other examples there as well, where, you know, those with the online channels have really been managing through this quite successfully. What about for you, Varun? Have you seen any
Yeah,
online coming through your industrial names?
definitely for a few of them, the more consumer-facing businesses, online distribution, or even just ordering online and picking it up on the curbside, that's helped a few businesses, right? Like Ferguson, Kingfisher, Travis Perkins. So if you're just ordering spare plumbing parts or hand tools or whatever it is, they were able to operate quite successfully through the pandemic. You just place the order online, turn up there on the curbside, be ready for you to pick up and go. You know, some of them even had an increase in online orders of a couple of 100% in that segment, coming off a lower base, but that definitely saved their hide. Now, the flip side of that is that it's hurt businesses that can't work online, right? Especially those with the heavy component of revenue from services. So when you think about installation, maintenance, repair, designing new projects where you need the engineers and the manufacturer on your site extensively, designing a new, whether it's an oil rig, production facility, whatever it is, those operations have struggled. Lockdowns meant some of them just weren't able to visit sites or clients, or even get together and discuss how to carry these out. And you can see that in the PMI data. By the way, the manufacturing PMI in Europe continues to grow to all-time highs, while services PMI lags quite a bit behind it. And once there's full freedom of movement across Europe, I think the two will catch up. You will have people being able to go out to sites and so on. We're already seeing parts of that in the UK, so it shouldn't be too far away. But I think more important, something that's been on the back of my mind, is inflation, quite specifically raw material cost inflation. And I think it's really starting to get mentioned a fair bit in the media as well. And the Fed and the various central banks talk about it every day as well. So what I'm seeing on the ground is there's a lot of cost inflation on raw materials broadly across the board, right? From metals, fibers, plastics, semiconductor chips, you name it, everything's up. But so far, margins at industrial businesses have not been impacted. They've actually improved, right? Because most of these manufacturers, they bought their inventory to manufacture with a couple of months, couple of seasons, quarters, or even some a couple of years ago. So they're now able to raise prices on what they're selling, but the raw inputs that they purchased were at cheaper prices. So they're able to actually get out higher profits. So that's worked out well, but that's not going to obviously carry on for much longer. So what happens if raw material prices remain high or continue to rise? Well, in that case, it's going to be the players who have strong pricing powers that are likely to do better, and they're probably going to outperform the broader industrial sector. In essence, if you can pass on your costs, your margins stay intact, you continue to be profitable. And I think this is where the really specialized manufacturers will end up gaining. If you consider those who manufacture high value items, in complicated rail transport, automation, electrics, or, think about the specialist pumps that are used in hospital settings, manufacturers like that usually have a lot of pricing power, and they're able to pass on all the raw material costs. And similarly, if you think about a lot of the distribution businesses, they like Bonzo or Brenntag or DCC, their business model has always been to pass on all the costs. They buy the material, stick a margin on it, sell it on. So they'll be fine even if there's substantial inflation. It's the less specialized, more commodity-like manufacturers, the ones who manufacture the generic nuts and bolts, small value items, and they have to compete on price. They're going to suffer if margin continues to get eroded by inflation. But on the other side, some of this inflation could be temporary after all, right? Much as the central banks keep saying at the moment, it's temporary, and there is something to be said about that, because we do know that a lot of supply chain disruption was caused because of the pandemic, and that is temporary, and it will eventually get resolved as things go back to normal. So if that is the case, we still think it's win-win, because those who raise their prices because of the temporary inflation, they're not going to lower theirs. So they're going to keep it up there and continue to earn margins. So the summary is good businesses with good pricing power, they're probably going to continue to do just fine.
Yes, I mean, that's probably one of the most important points to come out of this reporting season, I think, just in terms of what it means for the outlook. I mean, on the consumer side, in terms of those raw material costs, you saw the beer brewers, even the Coca-Cola bottlers, such as, Coca-Cola Hellenic or Coca-Cola Euro-Pacific partners, as they're now known, they really spoke to those higher input costs. So whether it be sugar or PET plastic bottles or aluminium cans, or even barley for the brewers. I mean, some of those input costs, they've been largely hedged to a degree. So a lot of the higher prices will be cushioned by some of those hedges in terms of on the gains. But the reality is that all that does is just buy them, time to push through high pricing themselves. So on the whole, what it means is that those consumer names, as you say, with those strong pricing power and brands, they're probably going to do a little bit better in terms of on the price increase front. So if you think of the luxury brands here, which should continue to do well, I mean, they've already been pulling the pricing lever in 2020. They're some of the key names that I think of in that regard. I think the other swing factor also here is that, look, margins took such a large hit in 2020, as they moved away from, the more profitable on-trade channels, the restaurants and cafes, they're away from home channels, Coca-Cola bottles call it, and more towards supermarkets and larger value packs. That's been margin dilutive. So as the channel mix normalizes, you're going to probably see a bit of an offset to some of these higher input costs in terms of margin. So it's certainly not all doom and gloom. There will be a margin recovery story to some degree as well as an offset. So there you have it. A stronger than expected start to the first quarter. You've seen a consumer that's largely been held up intact thanks to the unprecedented fiscal and monetary stimulus. And that's meant, the consumer for the large part has emerged in pretty good shape. But the recovery really isn't broad-based just yet, and there's certainly pockets that have done it tough. Meanwhile, the more agile companies, those that have been able to, trade through the online channels, they've managed to outperform and have a certain level of revenue resilience than those that could not, making that omni-channel experience all the more important. And then going forward, how should investors really be thinking about this higher bout of input costs? Are these supply chain related and therefore just transitory or temporary? Or is it really a case of inflation begets inflation and things become more structural and more permanent in nature? At the end of the day, identifying good quality companies with strong branding and pricing power, that's really never been more important. Certainly a topic to watch. And with that, I'll leave it there. Thanks for all your time, Varun.
Thank you.